What is up, everybody? Welcome back. Fresh Finance. Today, we are going to be talking about income and tax planning. Kyle, I'm super excited to start getting this episode going. But one of the things that I think is super important on this parameter of financial planning is normally it's the one that people are most interested in. It's the most intricate. And it's the one that you really want to make sure you're dealing with the right people, because it can be the one that can be the most detrimental if you do it wrong. And so kind of diving in here, we kind of want to break it up into, I would say, either, 2 or 3 different segments. So the first segment, we're kind of going to be talking about the income side of things. What are the different types of income streams to be looking forward to maybe go after? And then we're going to be kind of talking about the specific tax side of things. And then we're kind of maybe going to dive in on the back end on kind of debunking maybe a couple of myths, looking at a couple of different strategy opportunities that we use frequently with, the households that we serve, but just kind of diving in here. So income, can you maybe, break down the different types of income that's out there, some of the things that you see people utilizing, and how we go about planning, through those things?
Yeah, of course. We could start with the most common one, which would be W-2 income, right? Most people in the US have W-2 income, and that could basically stem from, getting paid by an employer via a salary, via hourly wages. You get a W-2 at the end of the year and you are a W-2 employee. And therefore, each time you get paid, if you have taxes withheld immediately from your paycheck, you are a W-2 employee. We can dive into that a little bit more because it is, again, the most common one. Then you get business owners, right? So business owners get 1099 income, right? 1099 income is super fun because you get to pay both sides of Social Security. Alternatively, with 1099 income as a business owner, you can write, as you pay taxes on your income as a business owner, you also are able to write off your expenses, which is one of the big benefits of being a 1099 employee. And further along than that, of course, you can have investment income, which can get taxed in a variety of different ways. You can get passive income, which can be through investments. It could be through rental properties. It could be through a million things, right? Passive income is becoming incredibly popular today.
Especially because of COVID. I feel like COVID was the side hustle year. The number of small businesses that opened up. I wish I had the number that 2020 and 2021 had. I mean, it was just ludicrous. Yeah, it really has. And I mean, honestly, when you think about it, can I make money without doing anything? Seems like the dream, right? A lot of, people are thinking early retirement. What's the best way of doing that? Well, you got to make money while you're retired via something like passive income. And we'll go through the different forms of passive income and how that could be taxed. Then there's residual income. So, I always think of, if you're a singer, if you're an author, or you have some sort of art out there, you can get residuals for your work. If you're in a commercial, for example, you can get residuals for that type of income, NIL players, what have you, right? And then, there's pension income, which kind of goes along the same type of retirement income, whether you have an annuity, whether you have an IRA, something, a pure pension, which are kind of going away these days as people live longer. But those kind of are the general all-encompassing forms of income, if you will, that are all treated very differently from a tax perspective. Yeah, and I'm really happy that we're actually going through this, because a lot of people kind of think it's the salary that you make and that's it, and then, if you're lucky, you've got a rental property, right? And there's so many opportunities, especially in today's age, ideas that you can just maybe start a quick little side hustle that you're passionate about, and that's something that I think we're seeing more and more frequently on the retirement side of people. Is they might be retiring from the job, in the industry that they worked throughout their whole life, but they're actually kind of using the beginning part of their retirement to pursue passion projects, and I think that's something that people should start looking at and maybe even trying to do while they're, in their working years, because the best way to invest more money is to make more money, right? It's obviously easier said than done, but starting to look at and evaluate opportunities where you can make additional monies while you're, in this accumulation stage, If you're anywhere from post-college, even before college, but post-college to retirement, if you can find some ways on, whether you're doing an audio book, doing an ebook, doing, any sort of Amazon drop shipping, if you're doing rental properties, if maybe, I've got a client that him and his brother work together, and they have a few medical patents, right? They make side income, they make royalty income off of those things. And, just kind of finding ways within what your knowledge and expertise is to generate some additional income. I think there's nothing but upside in things like that.
Yeah, the list goes on and on. I've got clients who, as soon as they retire, even before they retire, they've got hobbies of creating things and selling them. Etsy was a huge thing for, so, but the thing about it is, you got to be committed to it. A lot of people are looking for that passive income. I've had so many clients who have a rental property, and it can be a hassle. Okay. When you're dealing with renters, something goes wrong, you have to fix it. So it's not like, okay, I bought this property because, a lot of other people are doing it, and now I'm good. Now I can retire. It's going to pay itself off, and I'm good. But, there's serious consideration that goes into it, right? You just can't buy, investment property in the middle of nowhere and expect it to do well. So, we'll go through the different forms. Again, I'm not spared. I love passive income. The idea of passive income is exactly what you want to work for. You want to put your active income into building passive income, right?
Yeah.
And another way of getting money into retirement accounts that I've always learned, and just coming from the planning perspective, is, again, you've heard this once, you'll hear it again, pay yourself first, right?
100%.
That's the easiest way to get it out. You don't have to spend it on frivolous things. It's already in the account, right?
Yeah, and that brings up a really good point. And then I wanted to say one more thing on the passive side that we were talking about offline earlier. And I was talking with a younger client who's a nurse yesterday, and we're essentially, she's just out of college, and she wanted to come to us and put together a saving strategy. And one of the things that we talked about is, I personally think that there's a huge disconnect in the order of operations when it comes to how money is utilized when it comes in on a monthly basis, right?
Yeah.
The correct hierarchy of order of operations when money comes in should be immediate expenses that have to be paid every month, no matter what. The second strategy, the second order of operations should be savings and investments. And I think that's where the disconnect is, because most people think the second order of operations are their discretionary wants, their discretionary expenses, and so that's one of the, the big myths that I think is really important, is you have to pay yourself.
Yeah.
And then that secondary piece on passive is, and I read this a little while ago, is passive income is everything but passive for a long time. And I think that's where our generation, kind of that, 20s to 40s age bracket is, age of social media, things like that. They think that, you buy a rental property and you're a millionaire, in a year, right?
Yeah.
And in some cases, somebody hits, a home run on a deal or two, and they're just right in the right market. It could be possible, right? But for the majority of people, you buy a rental property and then you realize, and we've got client experience to back this up. They buy that rental property and they realize, yeah, there's definitely some perks. There's a lot of outlaying of cash flow at the very beginning, because you got to put the down payment down. Normally it takes some time to find, renters, to people to actually pay, the mortgage on that thing. And then you got to worry about property taxes every year. You got to worry about maintenance. You got to pay the property management group if you're utilizing one, because if you're not, then it's all on you. And so there's a lot more that comes to having passive rental income than a lot of people think.
Yeah. And, there's a lot of, it seems in recent hindsight that real estate is a no-brainer, because if you bought it 2019, 2020, it's done nothing but go in one direction.
Oh, yeah.
Right? It's gone up in price, and you're making money, which is paying for the, the mortgage in and of itself. It seems like a no-brainer, but you can't always say that, because, there's risks to everything. And like you mentioned earlier, Thomas, there's a time requirement. It's not just easy breezy. You buy it, you're done. Right. So there's definitely a lot more to it there.
Yeah, dude. And honestly, like, I don't like to look into the past too much, but if I had a time machine and I had a client who had a lot of cash sitting around, I would have told them, hey, you know what you should do is you should go to a site that's got a new build of single family housing, and you should buy up as many of those builds as you can, because I have so many friends that are around our age that are buying primary residences for the first time. A couple of them did new builds, and by the time it even got built, you're talking a 6 to 10 month time frame.
Yeah.
The home value went up 80 grand. It's like you could have just bought the new build, and nothing was even really there for the first couple of months, and it's just exponentially increasing.
Yep.
But we're in the past, and we're kind of at a sell high, buy high environment anyway. So
yep.
In the past.
That's exactly right. Yeah, I know. I just sticking on this point. I just had clients who were very lucky in this inflationary environment that they did a new build probably 6 months ago.
Mhm.
And at the time they purchased the materials required for the new build. Let's say it was $50,000 for the materials. They're now worth 100. The lot of land that they bought is now well above what they purchased for it. So they could just turn around and say, never mind.
Yep.
Make some money.
Exactly.
Yeah.
And flipping is hard too. We won't even get into that.
Yes.
But let's kind of dive into the base tax side of things.
Yep.
Kind of moving on to the next part. What are some strategies that you utilize frequently or talk through frequently, with the households that you guys work with?
Yep. And I would really start this conversation off with understanding, taxes. Taxes are something that occur all year. April 15th is just the day you kind of turn in your scorecard, if you will, right? So the
Great
whole
point.
year if you're a W-2 employee, so you get paid $1,000 a week, right? And you're withholding, which means sending taxes to the government before you receive it. You're withholding, say 10%, right? So you're receiving $900, 100 goes right to the Fed, right? The IRS for your taxes,
Mhm.
right? So that is W-2 income. And what we often do is, if it's purely W-2 income, you are a single family, or, you're a one person or a married individual, and you and your spouse only have W-2 income, no other income coming out there. It typically figures itself out, because if you look at your pay stub, you'll see your withholding, and you will be withholding as either a single individual or a married individual.
Yeah.
And depending on that will affect how much you're withholding. So typically, when you do your tax return, whether you get a small refund, owing to the IRS, it's really dependent, if you're just pure W-2 income, upon your withholdings. So some people, no one wants to pay money to the IRS, right? I do not want to pay a single dollar because it bothers the heck out of me when I have to do it, right?
Yeah.
And even to the state government, just a little, it's more of a nuisance than anything. So we always try to understand how our clients feel about it. And if you want a few extra dollars from your tax return, some people like to save with their tax return. They're like, I will withhold extra so I get that big payday in April, right? Or when I file my taxes.
Mhm.
So you can work with that. You can increase your withholding. If you're consistently sending money to the IRS for taxes each year, increase your withholding through work. And that's a direct way of kind of diminishing how much you'll owe.
Yeah, for sure. And some people are on the flip side of that. You're like, I want to try and give as little as possible to the government throughout the year so that I can have that in my pocket and I can use it as I please.
Yep.
And here's kind of a case in point on your side, right? So I work with some professional athletes, and I would say this is similar to anybody that has income in multiple states. But any professional athlete that you watch on television, they pay state income taxes in every single state that they play in. Doesn't matter if it's one game or if they play their entire season there.
I didn't know that.
Yeah,
I would not have guessed that either. I would think it's the state that they call their home residence. So when athletes move to, say, Texas,
mm-hmm.
What's the purpose there? Is it because they have the majority of home games, I would assume?
Well, it kind of depends. I mean, if you're playing for a team that's in Texas, that's really great, because in most situations, every organization in sports plays half of their games at home and half of their games on the road. So if you play in a state that has no state taxation, that's really nice. But a lot of the reason why those professional athletes will do that is primarily for endorsement income, because that is where it's going to get taxed, but also for their original signing bonus, right? So that's the other piece. Is we really like trying to put together strategies for them, on the signing bonus side, where they're residents at the time of signing in a state that doesn't pay state tax. But kind of back on the Fed side is we like doing larger withholdings, and even the organizations help us out on this. They're normally pretty good about it. But we like doing a larger than normal withholding on the Fed and the state side, because it's just such a gamble, because there's so many games, especially on the baseball side, 162 games a year. We just finished a return for one of our guys, and he played in 22 different states last year. He had to file.
Be his accountant.
She was like, oh, thank God that, we've done this before. But, we had 22 different state tax filings. I mean, his tax document was like this thick, I swear to you. But that's kind of a situation where, hey, having that larger withholding can sometimes be beneficial, because it creates that barrier of error in the actual employer's side of things. Because if we spread the margin super thin and the organization messed up on their withholding, then they could owe a huge tax bill. And we have actually run into that situation before with one of my guys on the signing bonus side of things. Right. And he had a huge tax bill. It wasn't any of, necessarily our fault, but it just kind of allows that barrier of error, that margin of error to make things a little bit more comfortable for people.
Oh, I have not been everyone's favorite person at tax time, whether it's recommending Roth IRA conversions, and then, it's just all of a sudden you see this tax bill and you forget about it. It's never fun owing a dollar, no matter how much it is, it's never fun owing the IRS. It's more of a nuisance than anything. And, understanding how the game works will help you play it better.
Yeah, I totally agree. But, the one consolation I always say is, if you're paying taxes, that means you're making money. And the more in taxes you're paying, to a degree, right? It's not how much you make, it's how much you keep. But the more taxes you're paying, that coincidentally means the more money you're making, right? And so, especially when it comes to investments, brokerage accounts, people are always, for some reason, upset about paying taxes. But in all reality, when you look at it from, a professional standpoint, if you're paying taxes from an investment perspective, that means that you bought something at a price and then sold it at a higher price. You did what you're supposed to do.
Yep.
Right. You're making money. We're getting off topic. What's the next thing? What's the next thing on your list?
We can certainly come back to that, because I do want to touch upon, how capital gains are treated, but we'll circle back around that. But let's talk about, on the flip end of that, paying taxes on gains. Let's talk about tax loss harvesting. One big thing that we do as financial advisors, whether it's an investment account, whether it's a rental property, there's ways with which you can either capture losses and or make your gains get taxed at a lesser rate, by combining the two. So let's say hypothetically, you buy a rental property and it wasn't in the last 3 years where it just went straight up, but you actually have a loss, right? Yeah. So if you have a rental property, let's say you put $500,000 into a property, and 5-10 years later, you're like, you know what, this thing's a dog. I think we should just get rid of it. And you come away with $400,000. That is a $100,000 loss that goes against your income. Okay, so if you make $100,000, you have a $100,000 loss. It's like you made $0 of income. And that is what we call opportunity, right? Right? Because all of a sudden you're at a zero. You've got a standard deduction that you can work with, that you're basically in the 0% tax bracket for a little bit. And, even further, we can get into the whole, when this occurs usually, and if you have an IRA, convert that thing to the Roth, right? Because you're paying very low, historical low tax rates while you still can. And there's a million other strategies you can do, but understand, do not waste an opportunity. If you have losses that you are able to put on your tax return, whether it's from an investment property or just a bad investing year, take advantage of that loss. Fill that back up with some other income that you want to capture, right? You've been sitting on some long-term gains in a certain stock, capture those. You could buy it back in a month. Right. Actually, I'm not even correct. When you sell it at a gain, you could sell it and buy it right back. And
wash sale only applies to
losses.
Yeah. And one of the things that I did want to hit on, this is something that people will come to me every once in a while with, is they've got a sizable investment loss like in the market, and it's to a degree. Well, it's a sizable investment loss. Maybe they went super high levered on one individual position and it didn't work out. And they're like, hey, can you help me write off this loss this year? One of the really important things to understand is when it comes to the market, when it comes to investment losses and an investment account, you can only utilize $3,000 a year in investment losses to offset investment gains. And so, a lot of people think similar to like a passive rental property that you can just write off the loss all in 1 year. There's got to be some carry forward. And I think that there's some good strategy to that, but you can only utilize at max, $3,000 a year on that front.
Yep. Yeah. And just to give that, an example is if you buy an investment, I hope no one ever does this, but if you buy an investment for 200,000, you sell it for 100,000, like if you bought something growth oriented at the end of last year and it dropped 50% on you and you decided to sell it.
Yeah.
Just like you said, if you have $100,000 loss, you can only post 3 on your tax return, but investment gains, let's say you have that $100,000 loss and somewhere else you have a $50,000 gain, those go hand in hand.
That's true.
And then you're left with the $50,000 loss.
Yeah.
Now, this could be a really good transition into discussing long versus short-term capital gains. Okay.
Yeah.
Now, in this exact same scenario, you go out and you buy a stock and it's worth $1,000 and you sell it for $2,000 within a year. 1 year, you have a short-term capital gain.
Mm-hmm.
And what that means is a short-term capital gain is taxed like you made it at work. It's at your ordinary income tax rate.
Yep.
But the IRS incentivizes long-term shareholders because if you own that stock for a year and a day or longer, then you get to do what is called a long-term capital gains tax rate,
Mm-hmm.
which under every circumstance is better because it's either going to be at 0%, 15%, or 20%, ignoring the 3.8% surcharge. But
Yeah.
that will every single time beat your ordinary income tax rate, and it doesn't tax like ordinary income. So there's a slew of incentives to, if you have conviction in investment, hold it long term, at least a day in a year, right? And if you're on that mark where you're about to cross the threshold of a year, wait a little bit longer. You don't want to let the tax tail wag the dog per se, but it's definitely something to consider there.
Yeah. And just quick kind of like, side note on this is when we talk about short and long-term capital gains, we're always talking about the idea of brokerage accounts, so non-retirement investment accounts. So if you just have retirement accounts, this isn't something that you'll ever really have to deal with. I wouldn't recommend never having a non-retirement account, but this is something you'll never have to deal with because while you're investing, there's tax deferral, so there's no sort of year-to-year taxes. And, depending on the retirement account, you're either pulling it out tax-free or it's coming out as, ordinary income. But, that's just an additional, kind of vote in favor of having, a non-retirement investment account. Having that brokerage account is you have that flexibility to help, mitigate or decrease your tax liability in any given year just for having that account and having, money invested in there.
Yep.
Allows you to be a lot more fluid. Let's take a look here. What else?
So I think what we can do from talking about investing is I want to go back to business owners and self-employment income, because I think this is very important to be understood for a self-employed individual is the opportunities you have. All right. So let's start with business organization. Okay. As a business owner, the most common structure of business ownership is what's referred to as a sole proprietorship.
Mm-hmm.
Okay, that's a one-person shop, one man deal. Whether you own a little bagel shop, whether you're providing lawn services, a carpenter, what have you, one-person shop, right? That's a sole proprietorship. It's just a pass-through entity that it's basically the exact same thing as, I don't want to say the exact same thing, but it's similar to getting W-2 income in that it's just pass through. You'll see every dollar you make is going to pass through to you, and it's taxed the same way as 1099 income, which means you're paying both sides of Social Security tax and Medicare. Then you get, you get S corps, you get LLCs, and you get C corps, right? And I don't want to dive too much into the intricacies and the application of them here because that could be an episode in and of itself. But C corps are typically your huge corporations. You don't really see too many C corps. I think, at least I haven't seen too many C corps as clients, as business owners, but they're far and few. They're far and few between. They're typically the much larger corporations are all C corps.
Yeah.
Smaller companies are usually, at least in my experience, going to be an S corp or an LLC, and an S corp can be no larger than 100 employees, and this could be like a partnership, right? So all the income is passed through to the individuals who own it. So let's say Thomas and I own a business. We make $100,000 a year. We divide, and we're 50-50 owners. Each of us will report $50,000 of income on our tax return, right? And any expenses we have, right? So if I have to pay for my car and I got to drive to work, I can write that off. My cell phone, if I use it for work, I can write that off. That is an advantage to being a business owner and having expenses as opposed to being a W-2 employee.
Yeah.
And an LLC is very similar in that you just basically, what you put into an LLC, let's say you start a business and it takes $100,000 to start up and everything goes awry and you get sued for all you're worth, but it was linked to the LLC, you can only get sued. You have limited liability only to what you put into that corporation.
Yep. The ownership and contribution of the corporation, and I always say on the LLC S corp conversation, because a lot of people will have issues on understanding the difference because there's not really a difference.
Yeah.
What I always say is LLC is the form of business entity. S corp is the form of tax structure.
Oh, yeah,
right? Because technically all S corps to a degree, unless they're a general partnership, are LLCs. It's just the way in which you'd like to pay your taxes. And there's so many advantages to being an S corp for sure.
Yep. And, even just beyond how they're taxed or how they're passed through to the owners there's a lot of incentives to being a business owner that the IRS gives you. And to kind of jump into a few. Recently, Trump's most recent Tax Cut and Jobs Act introduced what's called QBI, Qualified Business Income. That means that I'm a business owner. I make $100,000 a year. My expenses are $40,000 a year. I have $60,000 of profit, right? So the new laws are you get to take a deduction for 20% of your profit, right? So 20% of 60,000 is $12,000. That's an additional incentive for business owners and can make a huge difference when it comes to tax time.
Yep. So
QBI is something if you're a business owner, your accountant's going to know it. And if you're doing your own taxes, you really ought to know it because it is an incredibly helpful thing to know about.
Yeah. And that's kind of like back on the athlete side is like, business structure, formation, making sure that you either, know it yourself or you have a team in place to help you do it. Is kind of, going back to this athlete side, right? We're seeing these NIL deals for the first time in college sports history. These superstar college athletes are making so much money in endorsement deals and sponsorships. And even the fact that they're receiving like apparel and gifts, those things are considered 1099 self-employment income. And so, for them ensuring that they have an LLC, that they've got, people in their corner that are, categorizing and calculating these sort of things, because, one of the biggest things is quarterly estimated tax payments as a self-employed individual, right? So, I'm self-employed. And so I have to make quarterly estimated tax payments because the income that I receive, the taxes aren't deducted like a 1099 individual is. That's the exact same thing for these kids in college that are making these massive amounts of money on these NIL deals. And if, they're just taking the money and running, they're going to have, a huge bill and possibly penalties for not paying those quarterly estimated taxes if they don't have the right people in their corner.
Yeah. And that's why I said the earlier thing, you do taxes all year long. April 15th is just the day you put in your scorecard, right? Because if you ignore it till then, you're going to pay the price, right? You could owe, all right, let even this, so if you're getting 1099 income as opposed to W-2 income, you're going to have the money, the taxes withheld directly. You don't even have to think about it, right? 1099 income, as you mentioned, Thomas, you have to pay quarterly estimated payments. You have to put money into the system as you go, because the government doesn't want you to go from January 1st to December 31st, making X amount of thousands of dollars, not giving them a dime.
Yep.
The government wants to make your interest too. They want to get all the money in the system so they can make the interest as opposed to us, right? So, you just want to stay cognizant. You don't want to have any surprises. Of course, if you make more money than you thought, you just have to adjust accordingly and less, so it's just having a plan and understanding how it works. Yeah, is the most important thing. And it really goes into, if you really want to lower your tax bill, it goes into one of our previous episodes for retirement planning, in which you can utilize different retirement accounts that can lower your income. Oh yeah. Right. So if you're an S Corp, you can have you're a sole proprietorship, you can have a SEP IRA, you can have an IRA, you can have a 401k. There's a whole lot of different things that you can contribute to that will help lower your tax bill. Yeah. Yeah. And kind of like I said on that episode, the greatest thing about utilizing those vehicles to reduce your taxable income is when you do that, the money stays with you. It stays with you and it grows, right? Yeah. Because a lot of people's solution to tax problems is buying real assets for the business. And kind of like I said in that episode, there's only so many real assets for most people's, small businesses that they can buy, right? And the best thing about retirement accounts is normally the threshold is very high depending on income. But that money is it's going to stay with you and it's going to continue to grow with you, as you manage it. And if you do it right, it can be an incredible future value. Yep. So I totally agree. What else we got? I want to jump into fun stuff. Things you hear that, I remember hearing things when I was younger that I just took for the truth because I didn't know better. So let's debunk some tax myths. Got it. Start with probably the most common one that I've found, and this is the one I believe for a long time, is jumping into the next tax bracket. Okay. Let's say, you get a promotion, you're married, and one of the spouses is working from home, and then they start working, and you make a whole lot more of income in your account, or you realize, oh my gosh, I just jumped to the next tax bracket. Mm-hmm. I just jumped from the 12 to the 22% tax bracket. All my income, I just lost $10,000 that I didn't have to for taxes because I just broke into it. Oh my gosh, why am I even working? Yep. It's a marginal graduated system. Okay. So let's say, the first $10,000 you make, and this isn't exact, let's say the first $10,000 you make, you're taxed at 10%. Right? So that first $1,000 is going to generate $1,000 that you owe in taxes. Then say the next 20,000 at 12%. So you make $11,000, 10's at 10%, 1's at 12%. And it keeps going up. The next bracket's going to be 22. You just barely break into that. It's okay. It's not the end of the world. Now, even kind of getting into the more complex side of things, then you have various tax rates, various tax brackets for things like capital gains that you want to understand. I mentioned earlier, you pay 0, 15, or 20%. If you're kind of breaking that threshold, I've gotten clients who have capital gains in their accounts who pay $0 in capital gains because their income isn't high enough for the government to tax it. Yep. Right. So just, everything with taxes. Did you think you'd know this much about taxes in your life, Thomas? No. It's not about, those who know the rules of the game tend to do better. And taxes is a pinpoint example of that, in that you really need to understand how it works. Otherwise, it could cost you very slowly but surely thousands of dollars over the course of your life. Yeah. And almost always when I run into a situation where somebody has that apprehension of moving into an additional tax bracket, whether that's, we're doing a Roth conversion, which I know is on the list, or, we're thinking about having some sort of a side hustle. I always go into the conversation of marginal versus effective dollar amounts when it comes to tax rates. And so that's kind of the big thing is it essentially marginal versus effective is what you think you're paying versus what you're actually paying. That's the very 30,000 foot view of it. And I'll tell you that if you're in the highest tax bracket, let's say you just barely jump into the 37% bracket, you're not paying 37% on all of your money. Like you said, it's a graduated system. And if you want some more information on this, feel free, give, Kyle or I a call, and we'd be happy to go through this in a little bit more detail, especially if it's on an individual basis. But just understanding that your marginal tax bracket is not what you're paying on all of your money. It makes your life a lot easier. And even kind of running into an example, if you are thinking about breaking into that tax rate, that new bracket,
kind of doing a quick little calculation on what that number actually looks like, almost always it's less than you think it will be.
Yes. Yep. Yeah. And you know what? I'm going to jump into the Roth IRA conversation before we go to our
Yep.
next myth, because it kind of works here. Marginal, again, like you said, it's the next dollar. You make an extra dollar. What's it taxed at? What's that tax bracket? That's your marginal. And your effective is, if you make $100,000 and you're in all these different tax brackets, but at the end of the day, you owe the government $12,000. It's going to say your effective tax rate for all your income is 12%.
Yep.
Now, I am not an accountant. You're not an accountant. I don't plan on being an accountant, but I've come across accountants who, they punch numbers into the system, and this is not at all disparaging accounts because, we work with a lot of great ones, but sometimes they'll get the effective tax rate and they'll say, okay, this is your tax bracket, right? You paid 12%, when in reality, their marginal tax bracket is higher.
Yep.
So sometimes I recommend Roth IRA conversions, and you're in the 22% tax bracket, 24% tax bracket. And I've had accountants come to me like, what are you doing? Their effective tax rate is 13%. Why are you converting at 22%? And again, this is going to be a conversation and a case study for a whole case study to get into Roth IRAs and really the thought process behind it. But it's all about the income that you are paying today, the tax you're paying today, 22%. Let's use that number. If you're paying 22% for your conversion on all that monies, and down the line in retirement, all you have to look at is 22% a better bracket than what it will be when I pull it out in retirement, right? And tax rates, I don't have the crystal ball, but they got to go in one direction at this point because we've got a huge $1 trillion debt on our hands. We got to address it. So how do you do it? You raise taxes. So that's kind of besides the point. But all it is your tax bracket today versus your tax bracket in retirement, whether or not you want to do a Roth IRA conversion. And the gravy on top is the way in between. It's growing tax-free.
Mm-hmm. Comes out tax-free.
Yep. So, again, that's something we always think of when considering Roth IRA conversions is your marginal tax bracket today and how you can take advantage of it. I mean, 24%, it's of course not across the board, but we found 24% to steal. It wasn't too long ago where people who are in the 24% tax bracket were in the 28 and the 32, right? So it's just understanding where we're at in tax brackets and where you are today and where you are in retirement.
Yeah. And to get super strategic here, if you're doing a Roth conversion and you have a rental property with losses, that is the perfect time to do it. Or if you're doing a Roth conversion and you've got some short-term losses that you can maybe expose real quick in a brokerage account, bing, bang, boom, you don't even have to withhold. You can just use those to offset each other. Or, and this is a situation where, and this is something we can maybe get into later, is I've got a client that has a beneficiary IRA. They have 10 years to spend down the entire account. And that money, when taken out, is considered ordinary income. If you want to offset that, contribute more to a pre-tax 401k.
Yep.
Right.
Exactly right.
Offsets the tax bill because you're getting the deduction on the front end on the 401k contribution, and it's decreasing your income. If you're kind of going dollar for dollar, it makes life a lot simpler that way as well.
Yep. Yeah. Inherited IRAs. Oh man, it's with the new Secure Act, that could be a whole nother episode in of itself, because there's some cool changes that really have changed a lot of estate planning, but sticking with our income and tax planning.
Yeah.
Back to the next bit. We kind of touched on this a little bit, but I've heard a lot of people say big tax return. I want a big tax return. That it's like my Christmas savings club, right? Yeah. That's when I get my vacation money. So I want it to be X amount of dollars. That's fine. I've got no issue with that. As long as you're saving, I just want people to understand how it works. If you are putting more money into the system, whether you're W-2, 1099, what have you, if you're overpaying your taxes and you're expecting a refund, what you're losing out on is your interest, right? That's all it is. So if you put $5,000 extra into the system early on in the year, you're just losing the very minimal amount you'd make in a bank account right now, but that's what the government would be collecting as opposed to you. And that's kind of really how I look at it. I don't know if you have a differing opinion there.
No, I don't at all. Outside of the athlete situation, it's just about, I think the bulk of it is just being efficient. Yes. If you're having huge tax refunds every year, you're not being efficient with your money. You're not being efficient with how much you're withholding on an annual basis from your income. Whether that's quarterly estimated payments for somebody who's self-employed, or whether that's, just withholding, from payroll on a W-2 individual. If you have huge tax refunds, you're not being efficient with your money. And I think that should be principle enough.
Yeah, and I totally agree. And I will say some people don't know how to save without it. And that goes back to the whole thing. Pay yourself first, right? Because if that's your version of paying yourself first, what's the difference in having that same amount you're overpaying go right into an investment account or some other account that's just sitting there? And then you're collecting the interest as opposed to the government.
Yeah.
Right.
Yep.
So kind of nailed that one in the head. That was an easy one. You know, I'd rather get a tax return than no. That's really what it comes down to in my game.
Yeah. Yeah. There's truth.
So next one is rental properties and or a primary residence and the tax deductions associated with it. Kyle, I want to pay off my mortgage because I want to write it off. Kyle, I want to do X, Y, and Z. I want to get a rental property for the tax deductions. You know, we hear this all the time, and I'm sure you do, you know, and just kind of debunking, you know, getting more into the complexities of, again, Trump's Tax Cut and Jobs Act in 2017 is if you ever looked at your tax return, you get a standard deduction or an itemized deduction. Okay. And what a standard deduction is the government says, okay, you're a single or a married individual. You get X dollars off. So let me explain that better. You make $100,000 of income. The government says, okay, we're going to wipe off $12,000 as a standard deduction. So we're only going to tax you on 88, right? And it's double for a married couple and even more if you're 65 plus. But that is what a standard deduction is. Now, more people are taking the standard deduction than ever before because they've kind of changed the laws around it and how it works. Previously, you know, you used to be able to itemize your deductions and fill me in if I blank on any of these, but you get your mortgage interest, right? You get you pay interest on your mortgage, right? You have a 3% interest rate on your mortgage. That's mortgage interest. You can itemize that, right? You have state and local taxes. So what you're referring to, you know, if you live in a state or you live in a city, you're going to have high local taxes. You're going to live in a state that has high income state taxes. These are itemizable on top of that. Charitable contributions. Charitable contributions are also itemizable. What's the fourth one I'm blanking on here? It's not a big one, but I'm blanking on it. But charitable contributions have taken a huge hit.
They have.
Because now people are taking the standard deduction because it's really hard to itemize your mortgage interest, your state and local taxes. Let me touch on this again. State and local taxes. If you live in New York, California, New Jersey, one of these high income tax rates, and you're paying $30,000 in state and local taxes, you're like, all right, cool, I get to itemize. They cap it at $10,000.
Yep. So
there's a lot of people very upset about that are high income earners that are trying to push that, but besides the point. So they cap that at $10,000. So unless you get $10,000 for your state and local taxes, unless you have a McMansion with a massive mortgage, you're probably not going to, make massive charitable contributions. You're probably not going to reach that limit of choosing to itemize rather than take the standard deduction.
Yeah, especially if you're married.
Especially if you're married.
Yeah.
So yeah, and people used to do more, it's not ideal, but people used to do more charitable contributions when they'd get the deduction for it.
Mm-hmm.
So that's just kind of, it kind of just goes into the whole story of whether you want a rental property or a mortgage purely for the sake of tax deductions. Recent law changes have made that less likely.
Yeah. Yeah, 100%. And that kind of gets into the conversation on the rental side too. Is that a deductible expense or not? And in most cases it kind of depends, but just essentially kind of this is the reason for our job, right? This is the reason for our industry is we utilize our knowledge and experience and, to some degree, to some capacity, the tax code that, we know and utilize, but also just clients having the ability to bounce these types of questions and ideas off of so that we can use, our independent expertise and thoughts when we're not emotionally attached to the conversation on what the pros, the cons, and the different strategies and opportunities that present itself in each individual case. I think that's just kind of the brick and mortar of what we do is we're kind of, an idea machine, right? That's almost all we do is people come to us with problems and we put together, neutral solutions, right?
Yeah.
And that's, at least of late, especially during tax time. I don't know if that's a coincidence or not, but that's kind of sums up what my job looks like.
I love, the more complex it is, the more I love it. And, we've said this probably in the first episode, but that's the beauty of the CFP and working with the financial advisor who,
Yeah.
the CFP is a foot deep and a mile long, meaning there's a whole lot to know and how things correlate with one another and the complexities of especially taxes. And again, just, understanding knowing the rules of the game tends to make you better at it. Right.
Yeah.
So just a couple, I only have one more thing that I wanted to really touch on too. And that was really, in investing world, we never touched on this. And investing, it was just, if you're a high income earner and you're getting dividends and you're getting yield and, you don't want to get taxed on it at the federal level, you can always go into what's called municipal bonds. Municipal bonds are something that we use a lot of times in non-qualified accounts, individual accounts, joint accounts to kind of help lower the tax burden, if you will. And then another just real brief snippet is 529 plans. If you have children, you want to save for college education, a way to lower your state tax bill, and it's dependent upon your state. So you want to double check with, a professional regarding this, but you can lower your state tax bill by contributing to a 529 plan.
Mhm.
So we have people who, they have children entering their first year of college and like, okay, I'm going to give them $10,000 to, pay for tuition. First, pass that through a 529. You want to pay $10,000 to the university, put $10,000 into a 529 plan, don't invest it, send $10,000 to the university. And in PA, the PA state tax is 3%. You just made 3% on $10,000. I'm not gonna tell you not to make $30 here and there.
Exactly.
Yep.
Yeah, 100%.
So, just a couple more ideas. There's plenty out there. But I think we kind of covered it up here.
Yeah, for sure. I think this was good. I think we went into a few things that we didn't think we were going to go into. And I think we hit all the talking points that we wanted to hit on. And I'm super excited for the next one. I'm kind of just dropping this now, but we're really looking to get into some actual case studies, on sample clients through various different age ranges, various different income ranges, various different strategies, kind of weighing the differences between some of the things that we're talking about on, Roth versus traditional, and some of those things. So, be looking out for those types of things here in the future. We're really excited about that. That might be more, if you're kind of listening more on the podcast end, that might be more of a video watch and listen, because we'll probably be sharing screens, looking at different charts, putting actual material together for those things. So be on the lookout for those as well.
All right. Awesome. Well, Thomas, it's always a pleasure.
Always a pleasure. Thanks for listening. Thanks for watching. If you're doing a little bit of both, appreciate it. And we're excited to be putting out some more content here for you guys. See you next time.